Welcome to the Practice Power Play. Today is our third episode, and I have the pleasure of introducing a good friend and business affiliate, John Scoble with Cost Segregation Studies Incorporated. We have worked with John on a lot of clients and saved them a lot of money over the years in terms of cost segregation studies for buildings, commercial real estate, as well as there's some really new exciting regulations coming through that really got enhanced with the CARES Act that John's going to talk to us today about and educate our audience as to how they can save significant dollars if they own their own buildings or have some significant leasehold improvements on the books. So John, welcome to the podcast today, man. I'm glad to have you. How are you?
Thank you, Chris. I'm well, and I appreciate very much the opportunity to have this conversation with you and your clients about the tangible property regs.
Well, we're really excited to have you, because over the past, we've had the opportunity to work with you and your company, Cost Segregation Studies Incorporated, on really helping clients save a lot of money. Because many times, whenever we see a client's tax return and they have their own building or they have significant leasehold improvements to a building that they may lease, we see a lot of times that there has been very favorable tax treatment taken on getting expenses on those properties that reduce their tax burdens. And a lot of times it's low-lying fruit, and I hear that through the CARES Act, we've really got some really great opportunities enhanced for a lot of people that own their buildings and or have significant leasehold improvements to even go back a few years and save some significant money. Because, John, this year it's really, really important because with PPP loans coming through that look like they could end up being a taxable event, clients are going to need to have some advanced tax planning to really help them offset any potential tax liabilities, especially during a hard year where we've had shutdowns and income interruption, et cetera. So again, thanks so much for coming on. What exactly are tangible property regulations in layman's terms?
They're also referred to as the repair regs, and they came about in 2014. What they provide is a clear guidance to a building owner, as you shared earlier, as to what they can expense and what they have to capitalize when repairing any asset within their building. So a lot of your clients may have gone through some renovations or improvements in 2019 or maybe even part of 2020. And we want to make sure that we, in essence, categorize those expenses properly.
Okay. And, just for the audience, typically, for those of you listening in the car or watching via podcast, the way the depreciation works, just for the layman out there, is if somebody, has a $500,000 building or a $300,000 leasehold improvement, the Internal Revenue Service has basically a schedule on how long you can deduct those. You have to divide it by either 30 years, 27 and a half years, and there's a lot of different options. And again, just to re-summarize, a lot of times, for lack of better words, there may be lazy tax preparers that just throw it right into the 39-year property and do not maximize or enhance those deductions. And that's where John really comes in. And thanks for that definition of the tangible property. Well, why are they so important? Why are the tangible property regulations so important right now, John?
Well, it goes to a little bit of what you shared earlier, because let's say they expend this money for the leasehold improvement or even for the internal improvements. Mm-hmm. They come back to you and you need to decide, okay, can we expense this investment in the same year? If you can expense it in the same year that they do these improvements, that's a great benefit to them versus having to spread that cost over 27 and a half or 39 years. Mm-hmm. It doesn't change the depreciation, but what it does, it front-end loads or accelerates the expense. And anytime you increase your expense, you lower your taxes. When you lower your taxes, you increase your cash flow.
Gotcha. That's a great summary. I appreciate that. So, to capitalize on that, to capitalize on that statement, you're saying that there's, potentially 2019 leaseholds, 2020 leaseholds or buildings that may have been put on the books at 30 years, 39 years, 20 years, that you may be able to go back and accelerate and recapture all of that either on an amended return or on a future return. So instead of spreading, let's say hypothetically, $150,000 leasehold improvement that somebody put into their building, you may be able to accelerate that and get that tax deduction right now. Is that an accurate summary?
Exactly. And the greatest part is that it doesn't require an amended return.
Oh, wow.
It can be built right into the tax filing which you prepare. And because you have an independent third party like us to prepare that work, it's an immediate acceptance because we stand behind what our work generates so that it's, there are any questions, you're covered, the client's covered with an audit.
Gotcha. And just to give some information, like Cost Segregation Studies Incorporated are a team of engineers that come in and do engineer-based studies on how these capital assets, these buildings and leaseholds are placed in service, and can really peel out some great savings. And so you just said that you don't have to amend prior years. You can basically make an accounting change and realize all of that on their, let's say, 2020 return, since we just have a few days left in the 19 season.
Well, what it is, there's a form, 481A. And what that allows you to do as their tax preparer is, in essence, bring forward everything that they didn't take advantage of. 7 years ago, they bought this building and they didn't do or didn't apply cost segregation. Well, you have the ability to bring to 2020 those benefits that they didn't take care of. And again, there's no amended returns, there are no red flags raised. It goes immediately to the bottom line.
Okay. I mean, that's some powerful stuff. How did do these regulations change past regulations?
No, they clarify past regulations. And that was one of the biggest, I guess, how can we say it, struggles that the IRS had. There were so many different past codes, regulations, etc. They took 10 years to finalize the TPRs. And so in a succinct manner, this new regulation, 263A, gives you, the tax preparer, a clear road of how to manage and how to apply the tangible property regs.
Okay. Now, we've heard of the de minimis safe harbor. What is that, and what other safe harbors are there, John?
Well, let me back up, and a safe harbor gives you, the tax preparer, comfort that if you follow the safe harbor, the IRS cannot look at any of the entries that take place. So it's really a safe harbor for you as well as your clients. Now, there are several safe harbors. There's the safe harbor of expenditures once a year that are $2,500 or less, and that's immediately accepted. Then there's the safe harbor for repeated expenditures, such as repaving, repainting, re-roofing, that your clients do once every 10 years. And again, there's an immediate acceptance of these expenditures that you can write off. The next one, there's a safe harbor for a small taxpayer. And that's a client that has revenue that's under 10 million or assets that are under 10 million. And what that allows is that you multiply the building cost by 2%, and then you take the lesser of either that number or 10,000. And if that expenditure is less than that number, you can write off that full expenditure as an expense rather than having to capitalize it. And being a safe harbor, there's no investigation, if you may, from the IRS.
We want to keep those investigations away. But the good thing is, if we have team partners like you with our returns and our backup, then we welcome any and all audit and reviews, because I's dotted, T's crossed, and again, you've been a great partner thus far. In your opinion, why haven't business owners and investors heard of these regulations?
Well, they've heard of them, because the IRS, they sent out feedbacks to the accounting community. And again, it took 10 years to bring this about and 4 times in modification. But again, what came out of this effort is very complicated. I don't know if you've looked at, but I've looked at the information within the IRS website, and it's about 20, 30 pages of explanations, Q&A about the TPRs. So again, to your point, this is what we do. Mm-hmm. This is all that we do. So we can spend the time to make sure that the numbers that are generated are compliant, and that you and your clients get the benefit of the tangible property regs.
Gotcha. Now, how do these regs fit with the cost segregation study?
Well, that's a good question. They're both tax saving opportunities. And you said earlier, change in accounting method. They're both a change in accounting method. They both require skill and understanding. And that, again, that's why your clients use Mahan and Associates. The big difference is the fact that cost segregation, that's optional. The tangible property regs, they're mandatory. So again, your clients need to make sure that the TPRs are properly applied to their work. And that's where we come in to support them and Mahan and Associates. So that's important, because they're mandatory. You want to make sure you consider them.
Gotcha. Now, did the CARES Act, affect cost segregation studies or tangible property regs?
Well, they actually affected both. And to your point, this year is very important, because they, in essence, corrected what was originally intended for the QIP. In the past, the QIP were recognized as internal improvements, but somehow they remained in a 39-year depreciation stage. Well, that was corrected. And so now these internal improvements can, in essence, everything that's identified as 20 years or less as a component can qualify for the 100% bonus, which means they move into the 5-year category instead of staying in the 7 or 15-year category of expense. So that's a great benefit of bringing that expense to a 5-year category. The CARES Act also brought in the 5-year carryback for NOLs, or net operating losses. So if you guys use cost segregation and the client applies it in 2020, well, let's say their year was not what they expected. Imagine that. And they've used all of that benefit, and there is additional benefit through applying cost segregation or the tangible property regs. Well, you can go back 5 years and apply that benefit to any net operating loss or in essence, tax liability that they have. You can match up that loss and lower, maybe even generate a refund.
Yeah, well, and that's powerful stuff, man. And again, to kind of put it into normal, day to day applications, because I know we're using depreciation and QIP, which is qualified improvement property, and depreciation and cost segregation and tangible property. But in essence, we're talking about buildings and leasehold improvements at an office, at a practice building, that compare it to, I know that most practitioners are very familiar with 179, right? They go buy a CAD CAM machine or a laser or a surgical instrument. They can accelerate it and take all of that depreciation in that current year. This is the same philosophy and methodology to your building that can really create some significant tax savings and tax strategy for the current year. And it's really powerful that you mentioned that CARES lets us go back 5 years now. So if we can generate a loss during this COVID year and we need capital and we want to go ahead and get those deductions and get maybe a potential refund from prior years, this will be the time to do so.
Exactly. And it's even more powerful when you look at the ability of, let's say, they purchased the building in 2019. Well, the 5-year carryback allows them to go back even further than 2019. They may not have owned the building. That's okay. The CARES Act, in essence, goes all the way through to their K1. So even if they didn't own the building in 2018, they can benefit from the 5-year carryback because it flows through, and you know more about this, to their individual K1 income.
Gotcha. So how do practitioners today that own their building or have, again, significant leasehold improvements? And what that means, again, just to clarify, is if you have a landlord, but all practices had to do the leasehold improvements, the plumbing and the electrical and the drywall and the operatories and the waiting rooms and all of that stuff. So if they have either one of those functions, they likely need to reach out to you and let you guys look at what opportunities are there. So how does that go? If I'm a doctor and I lease but have $250,000 in leasehold improvements that I put on my books, or have a building, what do I need to do to know if I need to call Cost Segregation Studies and John Scoble, and how does that process work, John?
Thanks, Chris. We try to keep it simple. What we need is the information from a tax preparer like yourself, and that if you have a depreciation schedule out there, if they can email me that depreciation for their building, even if they've owned the building, let's say 10 years, and they may think, well, I've already used all of my 5-year, or I've already depreciated all of my 5-year property. Well, no, actually, if it's set up on a 39-year depreciation and you've owned it for 10 years, you've only used 10/39ths of that asset.
Right.
What we want to do is identify those 5-year components and fully depreciate them. We do this through a beneficial analysis. If you give us that depreciation schedule, we give back to you and your client an analysis that shows both sides of the coin. Here's the opportunity of cost segregation, and if there is an opportunity for the tangible property regs. We will recognize that as well on the analysis. We'll also give the other side of the coin. Here's the investment to gain the compliant study. If those numbers offer a multiple of benefit of 8 to 10 times, why not move ahead with it? If it's, only 2 times, well, again, we let you and the client decide, do we go further? And then, and only then, do we start our study? So there are a lot of things that we cover beforehand to make sure that their investment is worth it.
So it's virtually a no-lose scenario. If they've got leasehold improvements on their depreciation schedule, if they've got a building on their depreciation schedule, if they send that to you, you'll do a complimentary analysis to see what type of forecasted return on investment they would have in these tax strategies. Is that correct?
Correct.
Well, that's awesome. How do they contact you, John? How do they get partnered up with Cost Segregation Studies Incorporated to do this analysis to see the benefit?
Well, either by phone, email, however they want to, contact me. My email is John Scoble, that's Scoble, at costsegregationservices.com. My phone number, 615-476-7449. And again, even if they don't have a depreciation schedule, let's say they bought the building in 2020 and their tax preparer has not prepared a depreciation schedule. We only need some basic information. The cost of the building, the type of building it is, and when they acquired it. Given those 3 elements, and of course, if there were any building improvements, let us know that, or any renovations, let us know that. Given that basic information, again, we use our 16 years of experience in doing nothing but cost segregation. We give them back and their tax preparer an analysis for them to look at, and exactly what you said. Here's the bottom line. Here are the tax savings that you can realize. Here's the investment that you make. We want to make sure that it makes sense for everyone.
Gotcha. Well, John, thank you so much for coming on our podcast today. Again, that's a practice power play right there, where you can go back 5 years, amend returns, create operating losses just by sending your depreciation schedules over to John Scoble and his company, Cost Segregation Studies Incorporated, and you have nothing to lose and a lot to gain. So again, John, thanks so much for joining us, and we look forward to hearing from you soon.
Thank you, Chris.